The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service Advanced Technical Analysis course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Then we'll move on to market equilibrium. Okay, again, we're thinking as a trader, as we go through these topics, we're thinking, what does this mean in the overall structure of actually practically trading these markets? Well, with market equilibrium, the fundamental changes in supply and demand for the underlying assets that make up an economy or another market, of course, will decide whether the economy is strong or not. When the supply and demand curve intersect, the market is in equilibrium. So that effectively there in the middle, that is our market equilibrium price. Okay. So this is where the quantity demanded and quantity supplied are equal. The corresponding price is the equilibrium price and the market clearing price. Okay, the quantity is the equilibrium quantity. It's the same for any product, any market, any commodity that trades with the supply and demand function. It could be said the same is for the Apple iPhone, and that is why it's priced as such. That is the amount of quantity that is produced by Apple and given to the market. That dictates price, and that is how they assess how to market a new product. Then if it's not receiving good sales, they'll obviously try and cut down on the price of that sale, and that will relate to a shift in either the supply or demand curve or movements along the curve, to eventually they will settle on an equilibrium price for the market. What is the best price to market the Apple iPhone so that it has the most revenue, or that the most quantity of products can be sold? That is effectively how we use supply and demand functions to price, of course. So this in the middle is our equilibrium price. What we can see here is movements up and down the curve. Again, just like suggested, this happens not only for the iPhone 8, it happens for the oil market, it happens for the gold market, it happens for equities, of course, across the world. We get movements up and down the curve, shifts in supply and demand like this, and they start to create new functions of price discovery. So the idea of market equilibrium really relates to fair value. Okay, that's the point I would like to make. Fair value in terms of discussing any market that you like to trade at any particular time. Let's say you have a level of confidence that the Nasdaq is strong during the course of the week. However, some short-term sentiment shifts and the market trades down quite strongly. Well, you will assess that and say, as a trader, is this fair value? If you're discussing market equilibrium, let's look at the S&P. Let's look at those correlated equity indices in the US, the S&P 500 and the Dow Jones perhaps, and they're trading among relative highs in the market, yet the Nasdaq is trading at lows of the day. Is this market equilibrium for US stocks? So that might be a question for you to actually look to get a buy trade there, or a long trade in a particular market. So again, try and relate this back to understanding the context of these theories in terms of trading the markets practically. Behavioral economics again. So this actually brings in quite a few points in terms of discussing the overall idea or confidence that you may have in trading. And of course, these behavioral economics just discuss us as human beings, as rational decision makers. Behavioral finance began from the anomalies that the prevailing wisdom efficient market hypothesis could not explain. Okay, so we've seen some discrepancies there with efficient market hypothesis. It seeks to incorporate then behavioral finance, cognitive psychology with conventional finance in order to provide an explanation for irrational investment decisions. At its core, behavioral finance is based on the notion that investors are subject to behavioral biases which influence less than rational decisions. Again, very important to note. So let's say you believe the equity markets are strong there, of course, to give you another equity example, yet one of them simply sells off very, very strongly. Well, you're going to look at that market and you're going to just think, well, as a behavioral student of the markets, there's no reason why the market should be down there. I'm going to take a long position in that market. Now, there's obviously a reason why this particular market at this time is weak. But it doesn't explain how our own emotions try and assess rationality with those markets and across different assets. We of course do this. We try and assess a level of fair value with our own behavior towards how we think things should be priced. So of course, behavioral economics tries to describe a level of overconfidence, a trader's intuition to overestimate their ability to process information and pick winning trades. That certainly happens, and that's a downfall, of course, to many retail traders. Anchoring. Fundamentally, anchoring draws on our tendency to attach our thoughts to a reference point, oftentimes our initial decision, and refuse to waver regardless of access to new information. Okay? Now, this happens, all of us, of course, as professional traders. You may have made a trade, and the market shows you £30 profit or €30 profit. Then the market pulls back, and you look for some news to explain why the market is trading back, and you cannot find news. But and although the correlated assets are not doing so, well, we tend to disregard that fact if we have poor risk management, and we simply anchor or hold on to that trade. Gambler's fallacy, again, a very important side of topic in terms of behavioral economics. The concept of gambler's fallacy here is connected to flipping a coin. Okay, now when you flip a coin, the probability of it turning up heads or tails is always 50%, regardless of the previous flip. Yet, even in investing, individuals will fail to recognize that past events are independent on the future. So certainly that brings us into game theory, which we'll discuss as well, where there is an argument whether trading is a zero-sum game. If you simply buy a market, choose to go long, and you have a profit target of 20 pounds or 20 pips, and your stop loss is at 20 pounds or 20 pips, what are the chances then you're going to be profitable? Is it simply a factor of 50-50? That's not the case. That is, of course, gambler's fallacy, of course. It depends on what market you're trading, depends on the volatility, depends on an absolutely huge amount, an unquantifiable amount of factors. And of course, the last real school of thought or discussion point when we discuss and observe behavioral economics within the markets is hindsight bias. Drawing its roots from basic psychology, hindsight bias is the belief that past events were predictable and should have been acted on time. In many cases, this is a form of rationalizing previous errors and can lead to overconfidence. Okay, totally normal, but we want to understand these are behavioral factors in terms of finance. Of course, you may have bought a trade and taken a nice €60 winner, and it's went another 300 pips, and you've said, well, I knew it was going to go up there. I knew I should have held on to that trade. Hindsight bias is, of course, a completely normal, rational thought process, but it shouldn't focus in all of these points: overconfidence, anchoring, gambler's fallacy, and hindsight bias. All focus on behavioral finance to try and digress over how we do make decisions within the markets.